Michael Burry, economic hell on earth is coming and 95% of people will not survive. Hello viewers, welcome to my YouTube channel. Today in this video, we will talk about Michael Burry prediction about economic hell. However, before we start our countdown, we would appreciate it if you would subscribe to our YouTube channel and also press the bell icon. So let's get started. All predictions that Dr. Michael Burry made are turning into reality. Just like the author R.L. Stine's storybook monster starting to come to life in the movie Goosebumps in early 2021, Michael Burry predicted we would face huge inflation for years to come and warned investors about the upcoming stock market crash. But no one listened to him. According to Michael Burry, there are three main factors that will cause the collapse worse than American economy's recession in 2008. Considering these three factors, Michael Burry has sold almost all of his stocks. You'll be surprised to know what he said in his tweet. He said, inflation appears in spikes when the spike is resolving. It won't be because of Biden or Powell. It'll be because that's the essence. The nature of inflation resolves fools people and then comes back when it comes back. Neither the POTUS nor the Fed will take credit. However, governments don't know that inflation returns in a more terrifying manner. The credit goes to the concept. Velocity of money. We can calculate its value by dividing GDP with the money supply. For instance, an economy transacted pizza. Only 3,000 pizzas were sold in this hypothetical economy. In 1 year, the price of each pizza is $10. We can calculate the GDP by multiplying 3,000 by $10. So let's assume $10,000 is the total money supply. We can find the velocity of money by dividing $30,000 by $10,000. So the answer, it's 3. This implies that the average US dollar was used in 3 transactions around the year. This is the velocity of money. Over the course of the past few years, the money supply has increased radically. Yet the velocity of money has failed to pick up. Velocity is nominal GDP over money supply. Q plus higher rates started to push him to. Yet we're seeing a tick up in velocity emerging from a narrative obscurity in 1978 and 79. Rising velocity trumped falling money supply to drive inflation higher and higher. The redux would shock. The attached graph is representing the velocity of money and money supply. A white line here shows the velocity of money going from 2.2 to 1.1 in 1990. It shows that in the past, the average dollar has been transacted 1.1 times a year versus 2.2. According to the latest data, it can be seen how well the velocity of money is rising. Again, if the velocity of money continues accelerating, this means inflation will be stronger. In another graph, Burry showed the nature of inflation, which is cyclical. In the 1980s, inflation returned roaring at 15% plus annually. Realized inflation has always been peaky, and it has never been just one peak. So it resolves a brief deflation in the 40s and 50s, or dissolution in the 70s, and then comes back. An inflationary cycle generally spans years, and inflationary eras have spanned decades. Human nature. The attached graph showed CPIs over the years and annual growth of US GDP. The correlation between these two can be seen. CPI goes up, meaning the GDP rises as well. This means with the crash in prices in the coming months, the economy will collapse too. With an overall economy going down, certain percentages of people will suffer more than the others. When something falls from the sky, it's not the fault of whoever put it up there in the first place unless the Fed put it there. Keeping in view the upcoming issues, the Fed is discouraging expenditure. However, the fiscal government is still spending. The Biden administration is releasing spending bills. This will be adding to the inflationary wave. Burry explained the phenomenon in a tweet where he said, with recent spending bills, including the student loan forgiveness, now approaching $2 trillion this year, we have the emergence of the fiscal put, not just for COVID anymore, and will be as good for America's economy as sugar for babies. Burry has very well explained the current economic situation with the help of analogy of sugar. When one gives sugar to a baby, he feels good, but with passage of time, he may become habitual of taking more and more sugar, eventually causing bad effects to his health. The way the fiscal government is acting is the same. They boosted the economy by spending trillions of dollars in the short term. However, in the long run, it'll crash. The economy will expect more money, and it will lead to a second, more severe wave of inflation. And though a strong possibility of the second wave of inflation is there, there's another more serious issue. The White House redefined what is a recession in July of 2022. One of the excuses for this act is that the unemployment rate was at 3%, which is an all-time low. In 2020, the unemployment rate was 15%. Therefore, 3% is still bullish for the economy. It's assumed that people aren't being laid off. The economy is strong. Work from home will in time be seen as a culprit. The approaching crash of employment will affect the entire economy, though this is a huge issue. There is yet another one more serious than this. Margin. It's when the investors take loans in order to buy the investments, and theoretically taking margins is not bad. However, it is pretty darn risky. For instance, you invest $50 in a brokerage account and get another further $50 in the form of a margin loan. If the portfolio goes up 60%, then your assets will be worth $110. On the contrary, if they go down by 60%, your assets will have a worth of -$10. Margin calls will not let your portfolio go to negative. In actuality, it's when the equity drops below the essential percentage of the portfolio margin calls force one to deposit some extra money in the account. If you will not comply, then the broker will sell your positions without prior notification and will charge an extra fee as well. Margin works great while on the upper side and performs worse on the bearish side. At the moment, we're on the verge of the largest bubble of margin in our history due to alternative investments. Futures and options margins have become riskier. Margin calls occur easily because of enhanced volatility. When an investor gets the margin calls, as the broker will be selling assets, therefore asset prices will be dropped. This situation will allow others to get margin calls and lowered prices and even more margin. Credit card debts further explode the scenario over the period of the last 5 years, rising up to 4.6 million. The reason behind this huge rise is the ease to access credit cards. Goldman keeps stepping in it. AIG was rescued to save Goldman from the other subprime issue that everyone swore would not be contagious. Goldman's Apple Card. More than a quarter to subprime borrowers, 3% loss rate on that business. As of Square, as discussed earlier, recession is a regressive tax implying that the lower class will be hurt harder. Goldman has given more credit cards to the lower classes. With the rise in inflation, the lower class will be suffering harder. Margin bubbles and the credit card bubbles will cause a collapse in the economy. So this was our today's video. I hope you all liked this video. Don't forget to hit the like button and subscribe my channel. And also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.